Cheers. Welcome to ASMR Money Mentor. We'll get started in just a moment on this Friday evening. I hope you're doing well. I hope everybody had a good week. Let's take a look at what we're going to be talking about today. Today, again, is Friday, March 14th. And I would like to talk through an appointment I had just recently with Fidelity. Remember, I'm in the month of March, I'm trying to determine with my money where I want my money to live, right? Earlier this week, we talked about maximizing your money. So if you're building your wealth, that's your number one goal, optimization. Not only managing the money that you have currently, which I think is more important than even trying to chase market returns or chasing more income. As we talked about, income is important, very important, but learning the skills of optimization, in my opinion, as a money coach, is more critical and important in the long term than chasing more and more money, because the reality is we may not make as much as we think we're going to make, right? In my career, when I look back over the past 26 years that I was with one company, I continued to get, as many people do, little increases every year. 3%, 4%, 3%, 4%, whatever it was never more than 8 or 9% in 1 year. And that just continued for 26 years. So I was keeping up with inflation, keeping my expenses down, and saving the difference. And so I think that that is so important. And what's going to happen then is you get closer to when you want to retire, whether that be early like I did at age 58. Well, it's actually at the end of my 58th year because I turned 59 in February. I quit on January 10th. And as I mentioned in last Wednesday's episode, I think that we need to always be looking at our money even if we stop earning income. Now, you guys know I'm making a little bit of money from YouTube, not much. But I love seeing that money come in because I'm saving all that money right now into a bucket on my Ally savings account. I love Ally Bank because you can create buckets within a savings account and earmark funds either to save into the bucket or to earmark money like I'm doing to spend it down. And so what I decided to do is create a bucket for YouTube income. I don't care if it was in 2024, 2025, 2026. I'm just going to keep putting that money into that bucket. And then I'm going to release it at 1 year into the future. I don't know when that will be. But the point I'm trying to make is that even though you get to a point where you stop having income coming in and you go into early retirement, you still manage your money. You still make decisions. And you guys know right now in March, as of recording this episode, I am still not sure if I'm going to bring all of my $1.3 million to Vanguard or keep some of it at Fidelity where it lives right now. Because you guys know, many of you that have been watching my episodes, that my company moved us from Lincoln Financial to Fidelity. I had no choice, and I'm fine with it. I like Fidelity. I like Vanguard. I don't think it really matters which company you go with as long as you're in low-cost index funds that ride the market of the S&P 500 or the total stock market or whatever it is. Well diversified. You're not just buying Apple. You're not just buying one stock here and there. You're putting your money into mutual funds or exchange traded funds that have a of, the money went to Fidelity. I had no choice. Great. I'm getting to the point where I now want to roll over my 401k into, remember, two buckets. What are they? A traditional IRA and a Roth IRA. And because some of my money in that 401k is with after-tax money, many people don't know, and many companies don't offer this, but my company offered a Roth 401k. So I could either contribute into the pre-tax bucket or the post-tax bucket. And so of my $850,000, roughly $600,000 is going to go into the traditional, that's a pre-tax bucket, which I don't need that money for a long time, remember? And I think I shared with you that money I don't need for 15 years. Why? Because I'm using the $400,000 in my Roth IRAs first. And so I had an appointment with a person at Fidelity that he really kind of blew me away. He was really nice. He was really knowledgeable. And he even said to me, you know what? No, we don't have to put you under assets under management. I can just give you insight into what I might do with the money. That doesn't mean you have to do it. So he decided to give me some information that I wanted to share with you in this episode. So a couple weeks ago, I went to fidelity.com and I said, Evan, why don't you just go explore, look at the mutual funds and figure out which ones resonate with you, right? Knowing again that my strategy is to use the Roth first. The taxable account, remember, is set aside. That's growing. That's in 100% stocks. But the other money, I want to make sure that those accounts are properly allocated to when I need the money. Something that I never thought about when I was building wealth, and that you may not think about either. But I said to him, and he actually said to me, he said, well, Evan, why don't you tell me what you think? And I said, okay. So I said, I was out on your website and I was looking at target funds. Remember, target funds are weighted to stocks and bonds based on what year you want to retire, right? So I was looking at some index funds called Freedom Funds with Fidelity. One was a 2030 fund, and it was in approximately 60% stocks, 40% bonds. So I felt like that might be good for my Roth IRA. That I would open with Fidelity, because again, remember, you can have one with Vanguard and with Fidelity as long as you only put the total dollar amount in every year that they allow, which I'm not doing anyway. So I was like, you know what? I'm going to use the Vanguard fund first, which is 50-50. It's well balanced. I don't want to lose money out of that because I'm going to use it in the first 6 years, starting next year. Then the next 6 years or so would be this second Roth that I'm going to have, and I want that to be a little riskier, so that's why I was thinking 60-40. And then it would balance itself out in the next, 15 years or so to become more into bonds right when I would want to pull the money out. So I was thinking that that would be a good fund. Now he came back to me and he said, I want to bring your attention to asset funds, which are not really target funds per se. They have the same, U.S. stocks, international stocks, and bonds and such. But he wanted to build a case for me for what they call asset funds. Like, for example, it would be, they call it like 60, which means it would be 60% stocks. However, the expense ratios are very different. To the tune of 1.2 for the target fund versus approximately 0.65 for the asset funds. So they're more expensive to own, and he said that they have a better track record over about 3 years, but when I looked at the 3-year returns, they were very comparable. So I sent him an email, and I'm going to have him write me back and have a discussion. Again, he's just giving me insight. I don't have to do what he says. If I feel more comfortable with the target funds, that's what I'm going to do. But I have not made up my mind yet until I get more information from him, and then I'll make that decision. Then for my traditional IRA, remember, I don't need that until like age 72. So that money can sit untouched for a long time. So I was thinking of a Fidelity fund of the year 2040, which is further heavily weighted in stocks to the tune of 84%, and 16% bonds, because in my mind then, that money will sit and grow, and if it tanks, I don't care because it's going to come back up. I don't need the money for 15 years or more. So now he did agree with my methodology, but he said we have a target fund, we have an asset fund that's 85% stocks, and I said, okay, but that one, again, was the expense ratio. Remember, the expense ratio is what you pay per year to own that fund. So let's do an analysis, shall we? And this is what I put in my email to him. I said, well, if I put 600,000 into my target fund per year, times 0.0012, I would only pay about $720 a year to own that fund. Okay? However, if I go into his asset fund, 600,000 times 0.0065 would be nearly $4,000 per year, which is $3,180 per year more expensive to own. Now, he said that the results would be better, but when I look at the ticker symbols and I look at the results, I'm not sure I'm understanding that. So I just need clarification. If it does outperform the target fund, then I will go, most likely, with the asset fund. Now, here's what I think he may say, and I'm not sure, and I'll probably share this with you later. It could be that because the asset would stay at 85% stocks over the course of those 15 years, the returns could be greater, because remember, mine every year would change to become more conservative into bonds, and so the earning potential would, I agree, be less. However, the cost would be more, but that would be outweighed by the growth potential of that money. However, I see it as a risk in terms of the sequence of return risk, which means, what if a recession happens 2 years before I need that money, and it goes down 20 or 30%? Then I would lose a bunch of money, right? But here's what I think he's going to say. When you have your money in a mutual fund within this traditional account, I can change that mutual fund at any time with no tax implications whatsoever. Am I making sense? So what if I do take his advice and I use that asset fund, but then I reevaluate after 5 years, after 6 years, after 7 years? I can always move it to a more conservative fund with no taxes whatsoever. So, in other words, you're riding the risk and saying, you know what, I don't need that money for 15 years. Let's see what happens in 10 years. Now remember, Vanguard said that bonds are going to do better in the next 10 years anyway, so that's why I'm kind of looking at the target fund. Anyway, I wanted to share that with you because this was just my first conversation with this person. We are scheduled for March 18th, I think it is, where they're going to help me move the money from the 401k into whatever mutual funds I decide to go with for the Roth and the traditional. I don't think I'm going to get upset and then move all the money back to Vanguard. I do like a blended approach. Some with Vanguard, some with Fidelity, I think is a good choice. Now, had my company not moved us from Lincoln to Fidelity, right, the few months before I retired, as a custodian, right, they moved that money. I had no choice. I don't think I would have even thought about Fidelity. So let me end with this. Sometimes with personal finance, as you're building your wealth and as you're making decisions, sometimes things just happen. Some things happen that are good. Some things may happen with your financial life that are bad, but you have to look at the things that are good as a gift. This person person also told me that even though I don't have to do assets under management, he said that I can give you recommendations free of charge, which I thought was amazing. So I'm going to wait to see what he comes back with, and then I'm going to talk to him again. I'm going to weigh my pros and cons. I'm either going to go with those 2 target funds that I mentioned, or I'm going to go with the asset funds that he mentioned for me as well. But you know what? Here's the bottom line. One time Vanguard said to me, Evan, you've got so much money in different buckets. Your expenses are so low. You're doing great. You don't need to chase market returns. You don't need to build more and more and more wealth. Just calm down, relax, and let the money continue to grow. It doesn't have to grow exorbitantly. Is that a word? Exorbitantly? Something like that. And maybe that's good advice for you guys as well, right? Just to continue to do what you can do with your money. Keep your expenses down, pay off debt, put it into these low-cost index funds that ride the market, and every year just evaluate as you go forward. And then one day, as I always say, once that engine gets so large, you can pull that trigger, maybe leave corporate America, leave your job, and then start navigating life on your own terms and manage your money, which is where I got to earlier this year. So with that, everybody, I'm going to go ahead and close out this episode. I will share with you my final thoughts on what I do in a subsequent episode. I appreciate that you guys are here. I believe in you and congratulate you for every step of the way. If you like content like this, give me a thumbs up. I'd appreciate it. Consider subscribing if you have not done so. And I will see you